Hello class, in today's lecture we're going to take a look at Chapter 6, Cash Fraud and Internal Control. And one of the main purposes of internal controls is to ensure that the accounting information that we're presenting reflects the actual reality of the underlying economic assets and the underlying economic transactions that are occurring to help protect those assets for the benefit of the shareholders and other stakeholders and promote efficient operations. In addition to having the CEO and CFO verify and sign off on the financials, Sarbanes-Oxley also has the auditors certify this system of internal controls to help reassure these stakeholders that the internal controls are properly in place. The internal controls are going to share some principles that are common to all companies. Those are going to be including things like maintaining adequate records, separating record keeping from custody of assets, and applying technological controls so that process is automated where possible to eliminate mistakes and also eliminate the possibility of fraud or someone trying to steal any of the assets or anything along those lines. One of the main assets that we're going to look at for these internal controls is going to be cash. In order for the internal control system to be effective, you want three basic guidelines to hold here. One, that handling cash is going to be separated from record keeping of cash so that the individual that is physically having control of the asset of the cash is not the one also recording what has happened to the cash. You want cash disbursements to be made by check. That way there's a verification and record of those transactions. And the cash receipts are promptly deposited into a bank. That way you have a third party verification of those amounts. Now when we talk about cash being a liquid asset, it's because it's able to meet those current liabilities effective immediately for cash if it's in the possession. But we also talk about cash equivalents, and those are assets that may not be cash but are able to be quickly turned into cash and can be used for that same function, to be used to meet those current liabilities, which would include things such as making payroll or meeting other upcoming current liabilities such as payment for supplies. Now the goals of cash management are going to need to make sure that the cash receipts are there to make cash payments when they're due. For example, if payroll is due on Fridays, it's important for the company to have enough cash on Friday to make those actual physical payments. Another goal here is to make sure there's a minimum level of cash necessary to operate. One example of this might be a retail store such as a Target or a Walmart having enough cash to put cash into the cash registers to allow the cashiers and operations to go forward to make change, for example, for customers coming through and paying in cash. Now, by separating these functions out and allowing the verifications to occur, it makes it very difficult for these type of mistakes to occur or these type of diversions such as theft to occur without being detected. So it makes it harder for those actions to be concealed, which is the more difficult it is to conceal these and the more difficult it is for them to go undetected, the better the internal control system is going to be. Errors do happen on occasion, though, and you need some accounting mechanism to show the amount of that error. One of these is going to be something called cash over and short. For example, if we had sales that were recorded on a cash register for $550, but the physical cash in the cash register was $555, we need some way in a journal entry to show what that difference is, and we're going to use this cash over and short line item in that journal entry. And we're going to use it as a credit where we have an abundance of cash, where we have too much cash. So it's going to represent that we have an additional amount of cash, so we'll use it as a credit in that circumstance. We'll also use it as a debit if the amount of cash in the register is short. So if we had sales of $625 but only cash of $621, then we'd have cash short for $4 and be recording that as our debit. Petty cash is another important system to think about here. It's important to have internal controls and it's important to monitor cash, but there are some payments and some operations that occur that it's not worth the restrictions on them. So one thing a company might do is take a set amount of cash out of those internal controls and use that for things that come up, such as miscellaneous items, such as buying stamps, shipping fees that might occur to where if you need on-the-spot cash to quickly make those transactions. The first thing you need to do is to, from an accounting standpoint, is to physically establish that petty cash amount. And we do this by debiting an account we're going to call petty cash by $75, and we're going to credit cash by $75. And essentially what this is doing is taking $75 as the credit from, you can imagine, our checking account, and putting it in a petty cash drawer. So a physical amount of cash that's present possibly in the office, in a front desk, and maybe locked in a safe, or just in an actual physical drawer of cash that's going to be free on hand to be able to use. And that drawer is something that's going to get checked on a periodic basis to make sure that it either has the correct amount of cash in it or receipts that are showing those expenses that have occurred. But the first thing we need to do is fund it, so we'll credit cash line item, which essentially is going to be what we're thinking of as our checking account, and then debiting or funding this petty cash drawer, creating this asset on our balance sheet. And then we may have these expenses that come up over time, miscellaneous expenses. We may have some transportation expenses, which would go into merchandise inventory, or just general miscellaneous office supplies and expenses that come up where it may make more sense to physically go to a retail store, pay cash, and then bring that receipt over for the petty cash drawer rather than trying to order it through finance department, for example. When it comes time to check the amount of the petty cash drawer and check the receipts, simply we'll total up the receipts for our debits, reflecting them as expenses during that period, and then credit the amount of cash. And this is going to be to reimburse the petty cash drawer. So we're moving cash again from the checking account to the petty cash drawer to replace or reimburse those expenses and receipts. If we wanted to increase the amount of petty cash in the petty cash drawer, we would perform a similar transaction as we saw when initially funding it. So we debit petty cash by the amount of the increase, here $25, and credit by cash by the amount of the increase, here $25. If we wanted to decrease the amount of the petty cash drawer, we'd do the opposite in terms of the ordering. So we would debit cash by the amount, here $20, and credit petty cash by $20. In this example, what we're doing is taking $20 out of that $75 from the petty cash drawer and putting it back into what we think of as our checking account. Similar to how we saw the cash register can be either over or short, so can the petty cash drawer, to where if the amount of cash still in the petty cash drawer does not, when added with the receipts, does not equal the fund total, we're either going to end up with too much cash in the petty cash drawer, or we're going to end up short. And we're going to use the same line item as a debit or a credit to reflect that cash over and short. Here, if there's a shortage, the difference is going to be debited to the cash over and short, and if there's an overage, the difference will be credited. Now we also want to make sure to reconcile our accounting information with what the bank statement is going to reflect. And there's going to be some timing differences to where the bank statement is not necessarily going to match what the accounting information that we currently have, because we may have some information that the bank doesn't, and similarly the bank may have some information that we don't yet have, but we want to reconcile those numbers to see where those differences are coming from. So one thing we might do for this reconciliation is add to the bank balance deposits in transit, where if we deposit, for example, an amount in the bank's overnight bin, we might show this on our books as deposited into our checking account, but the bank doesn't know they have our deposit yet, so it's not going to be reflected on the statement. Similarly, if we write a check to a supplier for an amount, that check may not have made its way back to the bank yet. We may take money out of the checking account on our books, but it's not going to be reflected yet on the statement. Conversely, the bank may have a sense of what interest has been earned or unrecorded cash receipts and may add that to our bank statement because they have that information, but we may not have included it in our book balance yet. And we may also get bank fees that are charged to us that without being given notice of that information, the bank will give us notice by the bank statement itself, so it will appear on the bank statement before showing up in our book balance. And then the third item listed here under the book balance adjustments, NSF, is going to be a non-sufficient funds check, to where if we collect a check from a customer thinking that pays towards an accounts receivable we might own, for example, deposit that check into our bank, we might record that as an increase or debit to our cash and a credit to that accounts receivable. However, if our bank checks with the customer's bank and the customer never had that money, that check might get returned as non-sufficient funds. So even though we thought we had that cash in our checking account, we don't yet. So we'd have to unwind that journal entry and go back and contact the customer regarding how to make proper payment. And then for either a book balance adjustment or a bank balance adjustment, there could be errors that occur. And these might be in favor or against favor for either the reconciliation or not. So we'd have to make the corrections to those book errors, and that can either be as an addition or subtraction. So how we're going to do this for the reconciliation is set out what the cash balance is according to the bank statement on one side, the cash balance on our accounting information or on our books on the other side, and go through and add these deposits in transit that the bank doesn't know about yet, subtract out the outstanding checks that they don't know about yet, and then any errors for or against to get an adjusted cash balance. So this is going to be the reconciled amount. We're going to do the same thing with our accounting information, to where any information we get from the bank in terms of interest or collections, and then subtract any bank fees that we may learn about through that bank statement or non-sufficient checks. And then, again, either additions or subtractions for any book errors to get an adjusted cash balance that should be the reconciled amount. So these adjusted cash balances for both the banks from the bank statement and from the book amount should match and be reconciled. Taking a look at an example here for bank reconciliation, we're going to first start on the left-hand side, looking at our bank statement balance. Here we have $2,050, but we're going to next add to it any deposits that the bank may not be aware of, such as deposits in transit, and we get $2,195. The next thing we're going to want to do is deduct any outstanding checks that the bank may not be aware of because they haven't come back to that check and they haven't made it onto that statement. So once we deduct out the outstanding checks, we've got an adjusted bank balance of $1,845. Once we have that adjusted bank balance, we're next going to go to our book balance on the right-hand side. Here we have a book balance of $1,405. We're going to want to add to it the note collections, as well as any interest earned that the bank may know about that we're learning about and need to make that adjustment on the book side. We're also going to deduct out any fees or charges that we may have incurred and any non-sufficient checks that we learn about. Once we make those adjustments, we have an adjusted book balance here of $1,845, which matches the adjusted bank balance of $1,845. So the fact that these balances are equal are what we mean when we refer to it as reconciled. It's also important to note that it's only the adjusting entries from the book balance side that need to be made. So we would have a journal entry for the collection of note showing a debit to cash and a credit to notes receivable. For interest earned, so a debit to cash, credit to interest revenue. For the miscellaneous charge, we'd have a miscellaneous expense as a debit, cash as the credit, and non-sufficient checks, we'd essentially unwind the amount we thought we had received from the customer. Here we debit back to accounts receivable and credit to cash, reflecting that change. But for the bank statement side, the bank will make those adjustments on the upcoming bank statement. So there's nothing we need to do from an accounting information standpoint on our side of things. Next thing we're going to take a look at is going to be the days sales uncollected ratio. And this is a measure that may be used by financial analysts to get a sense of how quickly we're able to recover funds that were sold on credit from our customers. The formula we're going to use here is going to be accounts receivable divided by net sales multiplied by the number of days. Here the number of days we're using is 365, but other texts you may find or other resources you may find might also use 360 for the number of days, representing 90 days in a quarter, 4 quarters in a year, 360. But although they give you different answers, the intuition is going to be the same between both formulas. And again, similar to what we've seen with previous ratios, whether we get a number doesn't tell us immediately whether it's a good number or a bad number, but instead better practice is to compare it either to a competitor to see if we have a better days sales uncollected amount than they do, or to prior years to see whether we're improving or not. Here, in this example, as Starbucks, our days sales uncollected is going to be 14.2 days. If we look at a competitor like Jack in the Box with 16.2 days, we're 2 days better in terms of collecting on those accounts. But if we look at prior years of a year ago, 2 years ago, where we were having days sales uncollected of about 13.2, 13.7, our average collection from our customers is about a half a day to a day slower than what it's previously been. So this is a little bit more of a lenient policy, but also might be costly in terms of the amount of cash that we have into the system that otherwise could be used by reinvesting it into our company to earn more money. So it's just something to keep track of and to know as far as whether we're being intentional with the amount of time we're giving the customers, or whether this is something that might be getting away from us, that we otherwise could be recapturing this money a little quicker and then putting it to better use for shareholders and stakeholders. And that's going to conclude our lecture on Chapter 6.